Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's going on in investment markets and what to look out for in the days and weeks ahead. So if you've not listened to last week's Midweek Markets and then the Sunday podcast, do go back and listen to them because I talk about the key levels on the major indices, particularly the US stock market, the S&P 500 and the FTSE 100 to look at. But then on Sunday, I talked about the ETF subsectors of the S&P 500 to keep an eye on, as it gives you a lot of insight into what the market is doing. And interestingly, we've had a slightly shortened week this week because of the May bank holiday, but we are now approaching those key levels, and it's interesting to see what is going on at a sector level. So the S&P 500, let's just start there because that's where all the action is happening. The S&P 500 has been struggling to break above its 200-day moving average. Now, if you recall, being above the 200-day moving average is generally seen as a bullish sign. Being below it, as we've been for a number of months now, is usually seen as a bearish signal. The S&P 500's 200-day moving average has been sat around about 3,000. And that level has been proving very difficult to break through. We've run up towards it and then pulled back. Well, in the last 24 hours, the S&P 500 did, in fact, break above that 3,000 level. And a lot of it was down to euphoria around, again, another potential vaccine or treatment for the coronavirus. As usual, we seem to get some hope and then it all pulls back when reality sets in. But we've also had news of various different countries starting to ease their lockdown measures. I mean, in the UK, for example, we already had announcements that most retail shops will be opening up in the coming weeks. So that's obviously been a positive for the market as investors have looked around the globe trying to work out from other countries that have already opened up their lockdown what the impact has been on the number of coronavirus cases and indeed the economic backdrop for that particular company, or country, I should say. So that has obviously been that was a positive win for the market. So the market broke above the 3,000 level, and as I stressed last week, that was a key level, and the market immediately tried to push much higher, it leapt higher, and of course, if we go above that 3,000 level, that will be very bullish for the market. But we need to stay above it because if you make a break above a key resistance line, but then eventually pull back below it, that's called a failed move. And there's a phrase that goes from failed moves become fast moves, and that could then see the market pull back lower and unwind. But yesterday we broke above the 3,000 level, but then we pulled back by the end of the day. So it was all very euphoric, and then reality started to catch up with markets, and we dipped back below the 3,000 level. So we pushed above the 200-day moving average, then closed below it. In fact, if you look at most days in the last month, the market has opened up strongly but closed weakly in the last 30 minutes. So it was really the same pattern we've seen for most of the last month. What it meant is that it set the stage for today, where we're trying to see, can the market break above the 3,000 level? And as I make this show, it has just opened in America and we already have broken above, but we're starting to pull back. So this 3,000 level is not quite in the bag as yet. But on a sector level, if you start to look at the sectors like I spoke about in Sunday's podcast, XLF, which looks at the financials, this was a particular sector that has been a laggard during this rebound. And that has broken higher, and it is starting to join in the rally. In fact, we're seeing a rotation out of the tech stocks, which have been the winners of this coronavirus sell-off. A rotation out of those stocks into more cyclical sectors, and in particular financials. Financials have rallied over 9% in the last 2 days. Now, that rotation is obviously very positive for the market because we don't just want the tech stocks doing all the heavy lifting, because if they do roll over, then it would threaten the market. So we're getting this battle between old world pre-coronavirus businesses and this post-coronavirus world where the retailers that you could use from home, like Amazon, were being the winners. So the next few days are going to be crucial in this battle of the bulls versus the bears. If the market is going to roll over, it needs to do it pretty quickly, because if the market continues to push higher, then it sets the stage for the market to ultimately try and push back towards all-time highs at some point, perhaps later this year, or even sooner, in fact. To give you some context how important the 3,000 level is, Donald Trump even started tweeting about the stock market again, something he hasn't done since the days before the market collapsed. So the market is at a key juncture. We are seeing more breadth. We are seeing financials starting to play catch up, and we're seeing rotation within the market. So there are a lot of ticks in the bull case for the market being able to push higher. There are, of course, still some cracks. Bond markets don't seem to be buying any of this. Gold markets also seem to be a little bit uncertain. But of course, economic forecasts are still very poor. Now, if we jump across to the UK, the FTSE 100 has broken higher as well. And as I make this show, the FTSE 100 is around 6121. So that's at some of its highest levels since March. So again, that's a positive for the market. We've seen the pound start to fall. That's partly because of Brexit as well. So for UK investors, they're also enjoying some of this uplift. In Europe, we are seeing the German DAX rally from a key level of about 10,400, which means that, again, is a positive sign for global equities. In fact, there's quite a strong correlation between German stock market and the US stock market. So if we see the German stock market doing very well, then it's good news for US stocks. Although the German DAX is still just about below its 200-day moving average. The FTSE 100 is well below its 200-day moving average. So the FOMO is still very much in the US, but is the rest of the world just about to play catch up? Now, while investors are trying to put the coronavirus behind them, seemingly, and the market is becoming more and more detached from the fundamentals of the economy and obviously corporate earnings, then the market continues to push higher. But there is another story we need to keep watching in the wings, and that is the US-China trade war. It seems to be that Donald Trump is antagonizing China. China are retaliating in a sort of with rhetoric, but we've also seen their currency weaken. And of course, Donald Trump famously accused China of being a currency manipulator. Don't forget, if a country, an economy, a central bank weakens its currency, it gives it an unfair advantage when it comes to trade. So we're starting to see maybe the early signs of a bit of unease in the trade war. And that's what gave the market a bit of a wobble yesterday. Once it got above the 200-day moving average on the S&P 500 in America, that late news about more angst regards between the US and China caused the market to pull back. So we've got to keep watching that. So overall, where we are this week is where the crucial point where the market is looking like it's going to confirm a bullish upswing, or we're going to have a pullback. And if we're going to have that, it probably best happen soon for those people still trying to short this market. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me, Damien at moneytothemasses.com is the email address. You can get me on Twitter, Money to the Masses with the number 2. We're on Instagram, of course, our Facebook community group, facebook.com/groups/Money to the Masses. And don't forget to subscribe to our YouTube channel.